I thought I would bring back Scott Ashline, and I have a lot of respect for Scott in a lot of ways. Like I said in the program, I put him on the hot seat around a strategy that he was recommending, and Scott's just really an incredible individual. So let me just reread his bio, unless you forgot or you weren't here. But Scott began his career as a financial services at Northwestern Mutual. In 1992, he focuses on supporting successful businesses, corporate executives, and other high net worth individuals to achieve their individual goals and objectives. Scott and his team have extensive experience understanding and dealing with the complexities of foreign national planning and underwriting. Please help me welcome Scott. Scott, welcome back.
Walter, how are you?
You are a repeat speaker. How about that?
I'm excited about that. Thank you for that.
Yeah, so we last you were about life insurance as an investment. And I think there's a lot of misunderstanding about it, life insurance and annuities, and people can give them a black eye unnecessarily. But now we segue, and we have a few minutes, and I thought it was super important to kind of like, okay, now how about life insurance as a wealth transfer vehicle? It's still an investment, but it offers tremendous leverage in dealing with lack of liquidity, because if your estate is over a certain threshold and you die and you own, illiquid assets, and maybe you can speak to a case study or two. I think if my memory serves me correctly, wasn't it Joe Robbie, the owner of the Miami Dolphins, died with a very illiquid estate and didn't have insurance and had to sell the team and generate all these dollars. So kind of speak to that initially, that liquidity issue.
Yeah. Thanks again for having me on. I'm happy to. So you're exactly right. I mean, there are, I guess I would say is, life insurance isn't always just, let's say, a one-trick pony. There are a lot of, uses for it. And last time we did talk about it, pros and cons from an investment standpoint. But on top of estate liquidity, I'll talk about that. I also have, a number of other options that you may or may not have thought about that I thought people would find helpful. So I didn't hear, I think Andy was on prior to me, Andy Ferries as far as estate planning, but just where we do a lot of work in that area from an estate liquidity standpoint is, currently for a married couple, the estate exclusion is $22 million. It's going to be cutting in half in 2026. And you're exactly right, Walter. For people in particular might own illiquid assets, i.e., real estate, et cetera, they don't want to have to sell the real estate to pay the taxes. And so in conjunction with the estate attorneys, we will have a separate trust set up to hold a life insurance policy, because one of the benefits is at all times, life insurance, the death benefit is always income tax free, but by holding it in there's a number of ways to do it, either in a special irrevocable trust, or sometimes it's owned by children outright. It is outside of their estate, and that makes it both income and estate tax free. And therefore, it really almost becomes the lesser of two evils. I mean, no one wants to pay, large life insurance premiums, but they'd rather pay, let's say, depending on the age of the person and the couple and health, but it's, generally equates to 10 to 20 cents a dollar in terms of premiums versus dollar to dollar to the IRS, and so it's kind of like using that term, it's the lesser of two evils on just making it a less expensive, but of equal importance, it's instant liquidity. And I think that's the thing.
Scott, tell me that again. So give me that equation, the relationship between the premium.
Let's say hypothetically, you have an estate where there's $1 million of tax due, okay, as an example. So $1 million of taxes due, we have different options. One is it's due 9 months after the death, in the second death, that is, if it's a married couple, in cash. And so there's issues on if we're in a down market in real estate, or if it's something illiquid. So we have some potential, or needing to sell a closely held business, to potential for some discounting if it's at a down cycle, or we can borrow the money. But we can also use life insurance. And so a typical example, Walter, in that is we can structure a policy where we'll pay, I'm using that example, about roughly $20,000 a year for 10 years. So a total of $200,000. And to my analogy on, we can either pay $1 million tax, out of the estate. Hopefully there's liquidity to do that. And if not, it could potentially be more than $1 million, but otherwise we would be paying the $200,000, where that's the 20 cents on the dollar, to an insurance company, on my point of being kind of the lesser of two evils.
Got it.
Does that make sense?
Yeah.
Yeah. So from and that's without getting even more complicated, but in a very low interest rate environment, and if people are needing very large amounts of life insurance, another thing we see quite a bit now is leveraging, where they might be financing using the bank to pay those premiums. They don't want to come out of pocket to pay those premiums. So banks love to lend on life insurance policies. And the reason why is they're always collateralized. So I get a lot of bankers knocking on my door all the time, wanting us to use them, because they know that at any time we're all going to go at some point. So they're always going to be collateralized from the death benefit. But at the same time, the reason they like life insurance as far as lending, to lend on, is those policies also, as we talked about last time, have a cash value that also collateralizes, their loan. So that's something that it makes that leverage, when I use that term, that 20 cents on the dollar, by potentially incorporating a bank to pay those premiums, it could be even less. And then ultimately the bank, we can pay back the bank out of other assets, or just have the bank as part of the death benefit. They would get their loan repaid at death.
Is that program called something?
Yeah, that the program is known in the industry as premium financing.
Okay.
And I could probably do an entire, I could do a whole session on that topic alone. So I'm just giving you a teaser on the topic, but letting you know that that's something that's popular, in particular with people locking in, low rates right now. But from so that's an estate liquidity. And I know I'm limited on time, Walter, but I thought I could give you, if you don't mind, I'll give you 4 or 5, maybe a few more, where people may not have thought about. And, I wanted to expand on your question to me, or your charter to me on, how do people use it as a planning tool?
Yeah, no, fire away.
So another area we see a lot is estate equalization. And what I mean by that is, maybe you have a family held business, and let's say, Walter, the son, has worked with dad for 20 years building that business. And Walter has a sister, Susie, who, never was involved in the business, but of course dad loves Susie just as much as Walter. And, but he wants that business to go to his son or daughter, whoever was involved in that business. So we often use, and especially you can imagine where we have families with multiple kids, and maybe 1 or 2 of them will stay in the family business. But the others are they're on their own, doing their own thing, and they didn't really want to get into the business. But the parents don't want to suddenly give equal shares of that business. They don't feel that's really fair, to the kids that weren't involved in it, nor practical. So using that as from an estate equalization standpoint, that was one I'm thinking of. Another one I see a lot is second marriages. In this day and age, people want to equitably take care of their kids. And in particular, if it's adult kids, sometimes we see a second spouse or third spouse might be in comparable age to their own kids. And so, one of the concerns is that if something happened to that person, hey, their kids aren't going to see anything for ages, because that money could go to the now second or third spouse, husband or wife. And then, if they're in comparable age, so they will use the insurance. So we have some pure assets that will go to one or the other, that we often use. So second marriage is buy-sell planning, meaning businesses, partners. Walter, you and I are partners in a financial services firm, and suddenly I die, and now my wife, who may not know anything about the business, is 50% owner of this business and calling the shots with you, even though you're working day in, day out. So we'll have a buy-sell agreement, which forces her to sell, forces you to buy, and the estate or the life insurance creates that liquidity. Another one I see a lot is special needs trust. When people have, maybe there's a child that, there's a special needs where they need to have some permanent insurance there because they don't know what exactly is going to happen with the family business. And that's kind of their, a lot of people have said to me, it's my safety valve money, where I just know no matter what, they're guaranteed that, my son or daughter is going to get a certain amount. Qualified plan. This is another one where, you've talked about maximizing pre-tax, whether it's defined benefits, IRAs, 401ks, et cetera. It's great that people take advantage of that from a pre-tax planning standpoint. But you've probably seen this, Walter, before, and I certainly have with clients, where they've saved money into those IRAs or 401ks over the years, and because they have assets in other places, they're just taking the very minimum out of those IRAs, that RMD, or required minimum distribution. And the reason they do that is because it's taxed at income tax. The thing that they don't think about is if they die holding that 401k, IRA, whatever the qualified plan is, it's subject to both estate and income tax. So now that, $2 million IRA could literally get chopped and, be worth, 20 cents on the dollar. So a lot of times people will use the RMD, purchase the insurance to pay, because they're not really spending it. They're only taking that money out because they have to, and they don't really need it to live. They're using that RMD money to pay for the insurance in an irrevocable trust, as I was talking about earlier. That creates the instant liquidity. It replenishes the asset, so it's not being depleted by 80%. Am I rattling off too many for you, Walter? I want to make sure these are helpful, because
they are. I think what happens, Scott, they're all valuable. It's we don't know what we don't know, and that's really what I want the audience to really be aware of. Last thing, and then we got to go.
Yeah.
But I love the estate equalization, second marriage, buy-sell agreement, special needs trust, qualified plan. But when you run an illustration, and I think it's super important for people to kind of see the math around life insurance, and because it can go and transfer outside of the estate tax-free versus dollars that are accumulating that are going to get hit by estate tax, there's an IR calculation. So talk quickly about how where that shows up, and how people can actually do a comparison. No life insurance with life insurance, because given those numbers, and one is after estate tax, it's very compelling.
Yeah, that's a great point. I mean, it doesn't always work. Yeah, I think that's the, life insurance isn't always the, going to be the only solution. But you bring up an excellent point. Is usually what we're doing is we're running all of the options and kind of running a plan or spreadsheeting and saying, okay, well, if we don't have insurance, what are we going to do? Because we still have to deal with the problem, and so basically, it's spreadsheeting or all of the different options, whether they were to borrow money to pay those taxes or not do anything and just have it come out of their own estate. And it really, once you run the numbers, and I think the key thing, and I stressed this last time, is, a plan is only as good as the underlying product that funds it. So, doing the due diligence on the product underneath the plan. And this is where, we see a lot of problems in the industry, in my industry, where I think there's not the greatest reputation, is just that I think a lot of high commission products are pitched and being used to fund the plan. So, getting, second opinions, third opinions, and making sure, like you say, the people run the analysis are aware of, the pros and the cons, and asking, the advisor that's, representing that or proposing something to you, that you're asking them, what's the worst scenario? Can you run that same illustration under a lower dividend scale, and and being clear and looking at the financial ratings of the underlying insurance company, and looking at just the fine print, and usually clients themselves, just your average person, they're busy, successful in their real estate business or their own business. They don't have the expertise to understand the nuances of how these products work. And I think that's the critical thing of being truly very scrutinizing, as you are, Walter. That's how we met, on how do these products work, asking the questions, what are the downsides, what are the upsides, and if the person can't answer those things, you definitely want to get another opinion.
Well, thank you so much for coming back on. I think your real huge takeaway is just get a second opinion.
Yeah.
And because the variation of what you'll see in a life insurance quote varies dramatically. So to keep everybody honest, you just want to make sure that a dollar is a dollar. And so I want to thank you for that, and thank you for your return visit, and we'll talk soon.
Yeah, I'm happy to be back. Good to see you.